Hello everyone. In this video I'm going to go through the second part of the equity valuation model notes for BU 483 for the spring 2020 semester. We're going to start off with the dividend discount models, and then we're going to work our way into the free cash flow models. So where we left off last time, I'd gone through some ratios, price to earnings primarily, and talked a little bit about price to earnings and price to book and price to cash flow ratios. And oftentimes the way those are used are to compare firms, so not necessarily for valuation, but to compare firms that are similar. So for example, we might look at three firms that are very similar, and we might look at the price to earnings ratio, and if two of them are about the same at about the same level and one is lower, the one that's lower could be lower because it's just not as good of a firm. But oftentimes investors that use fundamental analysis will see that and sometimes come to the conclusion that the firm with the lower price to earnings ratio is undervalued. And sometimes what happens in that case is that those investors will purchase that firm in the idea that the price will rise to match the price to earnings ratios of those other firms. And in some cases you have activist investors that go into those companies that are quote unquote undervalued and replace management because they're looking at the assets of the firm, and the idea is that if the firm is underperforming in terms of the price to earnings ratio, it could be because their assets are just fine, but they have the wrong people managing those assets. So that's something to keep in mind, and how those are those comparable ratios are used in many cases. So today we're going to talk about cash flows and determining the value of a firm based on the expected future cash flows it's going to generate for its investors, discounted back at the required rates of return. And that's the underlying theme of the next three models we're going to look at: dividend discount models, free cash flow to the firm models, and free cash flow to equity holders models. We'll specifically work examples with dividend discount models and the free cash flow to equity model, free cash flow to the firm models. Free cash flow to the equity holders is very similar. It's not used as much, and we'll talk a little bit about when you would use one model instead of another. Okay, so let's start with dividend discount models. When valuing securities, we must discount the future cash flows to today's present value. Discounting equity is more difficult than valuing bonds because future equity cash flows are less certain. So think about it. When we look at a bond, we know what the cash flows are going to be. We know you're going to receive a coupon payment at set points in time, and we know you're going to get that par value at maturity. If that doesn't happen, that's because the company has gone into default. And so we know what the cash flows are. We don't know, and the market sets the rate for the required rate of return based on the riskiness of those cash flows occurring, and that's the yield to maturity. If a firm becomes riskier and less likely to pay back its bonds, the cash flows, the expected cash flows, don't change. It's just that the yield to maturity will increase, and that will lower the value of the bonds. With stocks, we don't know what those future cash flows are going to be. We'll estimate what they might be in the future, or what we expect them to be in the future, but they in themselves are risky because we don't know, not only because the firm doesn't have to pay them out, but because we don't know what they're going to be. So keep that in mind as we're going through that. It is more difficult to value equity than it is to value bonds because we don't know, first of all, we don't know those cash flows. Secondly, we don't know what the required rate of return is. We estimate that as well. When we look at a bond, we know what the required rate of return is because that's the yield to maturity that's publicly available for that bond. We don't know with stocks what that is because we can't ask all of the different investors in that bond what their required rate, that stock, what their required rate of return is. So in the dividend discount model, or DDM, dividends are the relevant cash flows. The rationale behind the DDM is that the dividends are the cash flows equity investors will receive in the future. Note, however, that some firms do not pay dividends and other firms reinvest a substantial portion of earnings back in the firm. The argument for using the DDM is that sooner or later all firms will pay dividends, and reinvestment in the firm will increase future dividends. A more complex model would also assume that the firm will pay dividends or they will repurchase their stock, because those are the only two ways that a company can give cash back to its investors, is by paying out dividends or repurchasing its stock from the investors. In order for an investment like stocks or bonds to have value, is that there has to be an expectation that the company will pay cash out to those investors sometime in the future. Otherwise, if there's no expectation of a cash flow, that investment doesn't have any value. The choice of the discounted cash flow model for valuation should be based on the subject firm's characteristics and the valuation perspective. Dividend discount models are most appropriate when the firm has a history of dividend payments. This provides the analyst with a history from which to extrapolate future dividends. Otherwise, it is difficult to forecast when a non-dividend paying firm will start paying dividends and how much they will eventually be. So if a company, I'll use Tesla for example because I used it last time. A company like Tesla has no history of paying dividends. It's hard to determine what those dividend payments are going to look like in the future. So Tesla is not a good candidate for a dividend discount model valuation. The second is that the firm's dividends have a consistent relationship with the firm's earnings. Dividends should be related to firm earnings if they are to be a good indicator of future firm and shareholder wealth. And the idea here is that you don't want the dividends, so the dividends won't be perfectly consistent with earnings, because earnings are going to be volatile sometimes. Right now is a good example of that. A lot of firms' earnings are going to go down. Those firms will not, in general, cut dividends or eliminate dividends as a result, though, because their investors rely on those dividends, and those investors wouldn't be happy to just have their dividends cut. So to the extent that they're able, the firms will continue to pay dividends. In the long run, though, to be a good candidate for dividend discount model valuation, a firm should have a predictable relationship between the dividends paid out and the earnings of the firm. The third and final reason when dividend discount models are most appropriate, the valuation perspective is that of a non-controlling shareholder. If the perspective is that of a controlling shareholder, where firm cash flows can be controlled, a free cash flow model would be more appropriate. And let me give you the example of Walmart here. So the Walton family owns, last I checked, a little bit over 50% of the stock. As a family, they are the controlling shareholder for that company. They can dictate pretty much, because they control enough votes for the board, the amount of the dividend, how much the dividend is paid. They can increase that dividend if they want to. They can decrease it if they want to. So they are controlling shareholders, and so a better model to use for them as controlling shareholders would be the free cash flow, one of the free cash flow models. For you and I, not controlling shareholders of Walmart, the dividend discount model is actually probably a good model to use, because it's very straightforward. Their dividends are predictable, and so it might work better for us, but not as well for them, to get an accurate view of the value of the company between the different shareholders. So the dividend discount model is a basic tool in valuing common stock. It's widely used and accepted among practitioners and academics. The DDM is based on the idea that the value of an investment is the present value of future cash flows, where here the cash flows are dividends. And you don't have to memorize this. This is just a representation mathematically of the dividend discount model. I'll just explain it to you. Here we've got each dividend paid divided by 1 plus the required rate of return raised to the time period. And then down here we have the horizon value after many dividend payments. H stands for horizon, so D sub H is the dividend at the horizon value plus the price at the horizon date, not value, sorry. The dividend on the horizon date plus the price at the horizon date divided by 1 plus the required rate of return raised to the value of the years until the year of the horizon date. And then we can simplify a little bit. It's the sum of all the future dividends discounted back by the required rate of return on equity plus the horizon price or horizon value of the stock discounted back at the required rate of return on equity. So pretty straightforward. The formula says that the value of common stock at time 0 is equal to the discounted stream of future dividends plus the expected price of the stock when sold at time period H. One of the main things to remember here is that the appropriate discount rate for a dividend discount model is the required rate of return on equity. The constant growth model is the model used when we expect the growth not to change. And let me explain one thing really quick here. That G value is usually pretty small. We're, in the long term, the long-term growth rate of dividends for mature companies and mature industries is about 3%. I've done a little bit of study on this and estimated it out. It should essentially be the GDP or gross domestic product rate of increase over the long term. So the reason for this is that anything larger would make the company get really, really big because this is a constant growth rate. It's expected to go on for a very long time. So anything much more than the rate of growth of our economy would make the company really big relative to our economy. So that's important to remember. There is a constraint in the long run for the growth of dividends for a firm. The formula assumes the following: that the required rate of return is greater than the long-term growth rate, G, and 2, said it twice, 2, there we go, that growth is constant. Okay, so I've got an example down here that I'm going to work through. The risk-free rate is 3%. The equity risk premium, and that is the required rate of return over the risk-free rate, is 6%. Beta is 1.2. The current dividend, and that's D sub 0, is $2. The dividend growth rate is 5%. And the current stock price is $24. So let's go ahead and work that out here. I'm going to use this model up here. And there's a mistake here. This should say D1 instead of D sub 0. There we go. Alright, so we would put in for D sub 0, $2. Multiplied by 1.05. Like I said before, that's actually probably a kind of high required rate of return for a constant growth model. Our risk-free rate, our equity risk premium is 6%. Our beta is 1.2, and our risk-free rate is 3. So our required rate of return on equity using the capital asset pricing model is going to be equal to the risk-free rate of 0.03 plus the beta of 1.2 times the equity risk premium of 0.06, and that's going to give us an answer of, so 1.2 times 0.06 is 0.072 plus 0.03 is going to be 0.102 or 10.2%. Okay, so I'm going to put 0.102 down here minus the growth rate. Oops. Here we go. Okay. There we go. So this is going to be, the numerator is going to be $2.10 divided by 0.052 I will use Excel here to determine that is equal to 2.10. Oops. Gives us an answer of $40.38. So the current stock price is $24. We would say that this company, this stock is, if our calculations are correct and our assumptions are all correct, we would say that this stock is currently undervalued. Since the price today is less than the intrinsic value. So the constant growth model implies that a stock's value will be greater the larger its expected dividend per share. So if we increase that dividend, that value is going to increase. The lower the required rate of return for equity, the higher the growth rate of dividends, and the rate of price appreciation. Oh, sorry. That should not be number 4. So under those 3 circumstances, the stock's value will be greater. The rate of price appreciation in any year will be equal to the constant growth rate G for a constant growth stock. For a non-constant growth stock, that's not the case. So if the stock is fairly valued, so the intrinsic value is equal to the market price, then the expected return on equity is equal to the dividend yield plus the capital gains yield, or D1 over P0, that's the dividend yield, and the capital gains yield is the expected change in price divided by the price today. So life cycle and multi-stage growth models, we're going to go through a few different dividend discount models that also can be applied to the free cash flow models. The ones we want to use are dependent upon where the company is in its life cycle. And let me give you a small caveat about the application of this to real firms. So historically, the literature has assumed that companies go through a life cycle. And if you might be familiar with this from your marketing classes, it's something called the product life cycle. And products really do go through a life cycle. You can think of most products, in 2006, the iPhone came out. It was huge. It was, overwhelmingly attracted the market share for smartphones because it was the real first smartphone. Grew extraordinarily fast. And did very, very well. The growth for the iPhone decreased over time, and we expect that to happen with a new product. Other products came in, substitute products came in. You got the Android phone, the Google phone, the short-lived Microsoft phone. I think it's still around, but it's not very popular. But other entrants come into the market. They take up some of that market share. They decrease the growth of the sales of the iPhone, and that's how a product goes through its life cycle. So eventually, the market will be saturated, and everyone who wants an iPhone has an iPhone. Now, they'll probably want new iPhones, which is nice because of it's a technological good, but the rate of growth will slow and become stable, because people already have iPhones if they want an iPhone, and whenever that iPhone wears out, they're going to buy a new iPhone probably. But they're not going to see a lot of growth in the numbers of people wanting iPhones. I hope that makes sense. And so what that gets back to is this idea that the growth in the constant growth, it tends to decline down to population growth and the rate of inflation, which is roughly the change in GDP, unless the technological advances allow us to become much more productive. So those are some things to keep in mind there. Products go through life cycles. Historically, it was thought that the companies that produce those products also go through those same go through those same life cycles. And what's the actual case is that many firms try to break out of that life cycle by coming up with new products, innovating. That's exactly what Apple has done. They started off really kind of as a computer company, not as an iPhone manufacturer, an iPod manufacturer, an iPad manufacturer. They made computers, and as they have grown and evolved, they still make computers, but that's not their main focus anymore. And so they've evolved out of that product life cycle that went along with the computers. There's a company, and really not around much anymore, that was a computer company called Gateway. They didn't really evolve out of that, and so that brand has really died down and went away as a result. They have followed a product life cycle. So I just put that explanation out there so to help you understand that you might see very old firms that have high growth rates because they are also innovating at the same time. So life cycle and multi-stage growth models. Most firms have non-constant growth in future earnings and dividends, so we need to use multi-stage models for these firms. For many firms, practitioners assume that growth has 3 stages, which are characterized as follows. The first is the growth phase, so this is when it's young, they've got new products out. It's rapidly increasing markets and earnings. They have high profit margins. They have heavy reinvestment. As a result, and I haven't gone through free cash flows to equity with you yet, but this will often result in negative free cash flows to equity because any cash that's coming in, they're reinvesting it back into the firm. So there's not cash available to pay out to stockholders. There's little or no dividends because reinvestment offers high returns, so putting the money back into the company generates higher returns for those investors, and growth eventually slows as competitors enter the marketplace. The transition phase, earnings are still increasing but at a slower rate as competition increases. Earnings growth is above average but is declining towards the growth rate for the overall economy. Capital reinvestment slows, resulting in positive free cash flow and increasing dividend payout ratios. So again, think of it when a company's young, they have a lot of good opportunities in front of them. Otherwise, they wouldn't, become a company if they didn't have a good product, and they wouldn't be successful in surviving that young age that companies go through unless they had good products and good ideas to invest in. At some point, though, they run out of those unless they're becoming very innovative. So eventually what happens is they are going to stop finding really great products to invest in or projects to invest in, and they'll start having cash left over, and they'll start paying that out to their investors and in the form of dividends and stock repurchases. The last phase is the mature phase. Return on reinvestment in the firm, ROE, return on equity, equals required rates of return. Earnings, dividend payout ratios, and return on equity stabilize to long-term rates. Earnings and dividends grow at the mature growth rate. And so you should expect at this point that payout ratio, dividends divided by earnings, is pretty consistent over time. And you expect them to grow both at the same rate. A firm can be valued during this phase using the Gordon growth or the constant growth model. Firms often try to extend the growth phase using changes in strategy or business mix. Technology may also change the duration of the growth phase. Nevertheless, the 3 stages here are a useful approximation for many firms' phases. Just to back up for a minute. So back in 2003, Microsoft decided to start paying a dividend. And so it's interesting because when a company increases a dividend and it's a surprise, their stock price will increase. If a company decreases their dividend or cuts their dividends and it's a surprise, the stock price for the firm will decrease. When a company initiates a dividend, in other words, they haven't been paying a dividend and they start paying a dividend, though, it's kind of strange because what happens is that sometimes the stock price goes up as a result of that announcement, and sometimes the stock price goes down. In the case of Microsoft, when they announced their initiation of a dividend, they had not been paying one, and now they're going to start paying one. Their stock price fell fairly significantly on that date, and that was a result of them signaling that they were transitioning from a growth phase, because there are little or no dividends, to a transition phase. They were signaling to their investors that they were running out of good investments to put money into, and so now they're going to start paying out extra cash. Their stock price fell because a lot of their investors at the time saw them as a high growth company and invested into Microsoft because they wanted that high growth. Microsoft was now signaling that that high growth was going to probably end. And so the investors did not take it well. The stock price fell. A lot of investors sold their stock as a result of that announcement. So let's work some problems. I'm going to be working these out in Excel, and let me know if you have any questions about them. So the first example is one-step growth. So the idea here is that and just to stop for a second, this problem up here is a constant growth formula. So we've done that one there. Constant growth of 5% a year. Very straightforward. One-step growth says that there's going to be high dividend growth for a while, and then it's going to drop off to a low and more stable long-term growth rate, to a constant growth situation. So ABC Inc.'s last annual dividend was $2.50. Management expects the dividend to grow by 9% for the next 3 years and then 4.5% thereafter. If the cost of equity for this firm is 12%, what is the value of the stock today? So I'm going to do this here in Excel. So we expect 3 years of 9% growth. So I'm going to put year growth rate cash flow. Okay. So 9% for 3 years, 0.09, 0.09, 0.09, and 0.045. Our cash flow, our last annual dividend was $2.50. So the cash flow, or the dividend at year one, is going to be equal to 1.09 times, so 1 plus the growth rate. Here, I'll just do that instead. 1 plus 0.09 multiplied by the dividend of 2.5. Oops. That's better here. All right, $2.725 for year two. Our dividend is again going to grow by 9% a year. So we're going to get this equal to the dividend multiplied by 1 plus the growth rate for year two. So I get 2.97. I'll just drag here for year three. I get 3.24, and all this is doing is taking that last dividend, multiplying it by 1 plus the growth rate. And then year four, at the end of year three, we switch to the long-term growth rate, the constant growth rate of 4.5%. So our horizon value occurs at the end of year three, because at the end of year three, we can now use that constant growth formula to determine what the price would be at year three. I'm just going to put here on the page that constant growth formula. So with the constant growth formula, it is that the price at time t is equal to the dividend at time t plus 1 divided by the required rate of return on equity minus, and in this case, understand that growth rate is the constant growth rate. So you cannot use this to determine the price at time 0 if it's a non-constant growth stock, in which case that's the case here. So for our example, the horizon time period in this case is time 3. Separately. So the price at time 3 is equal to the dividend at time 4. Divided by the required rate of return on equity minus the growth rate. Our price at time 4 is 3.3833. I'm sorry, our dividend at time 4 is 3.3833, so our horizon value at time 3 is equal to that dividend divided by the required rate of return on equity, which is 0.12, minus the constant growth rate of 0.045, and that gives us a value at time 3 of $45.11. Okay, and just to go back up to this equation up here, I've got my dividends. I've got dividend at time 1 of 273, my dividend at time 2 at 297, and that's all the dividends until the horizon time period. So this is our horizon time period because that's where the constant growth starts. And so our horizon value, this P sub H, is 4511, and the D sub H is 324. So now I'm going to add these cash flows together for each time period. And for years 1 and 2, it's just the regular dividends. And now I'm going to use NPV in Excel with a rate of 12%. And then I'll just highlight those 3 cash flows to get the value of the stock today, which is $39.21. Okay. So I found the present value of all the future cash flows up here, discounted back at the required rate of return on equity. So our value here is $39.21. Right. And again, let me know if you have any questions on how to calculate that. The second is two-stage growth. It's the same idea, except for we don't have just one period of high growth. We have 2 periods of high growth. It usually goes really high growth, and then that growth reduces and continues on for a while, and then we finally go down to the constant growth for the firm. So in this example, XYZ Inc.'s last annual dividend was $4. Management expects the dividend to grow by 20% for the first 2 years, 10% for the next 2 years, and then 5% thereafter. If the cost of equity for this firm is 15%, what is the value of the stock today? So again, I'm going to go out here to Excel. I'll do my same setup. So my growth rate is 4%. Is 20% for 2 years, 0.20, 0.20, 10% for 2 years, 0.10, 0.10, and then 5% thereafter. So the constant growth starts after the end of year 4. So our horizon time period is year 4. Because our constant growth starts the next year. Our last dividend was $4, so our first cash flow is going to be $4 multiplied by 1 plus the growth rate of 20%. That's going to give us $4.80 for our next dividend. And then we can just take that, multiply it, $4.80 multiplied by 1 plus the growth rate. And now that I have that in, I can drag that all the way over to here and get the rest of my dividends. Okay. Just like I did before, let me make this look nicer too. There we go. Just like I did before, I'm going to find the horizon value at year 4 by taking the dividend at year 5 and dividing it by the required rate of return, which in this case was 15%, minus the long-term growth rate of 5%. So it gives me $73.18, and so that's the horizon value. And now what I'm going to do again is find the present value of my expected future cash flows. And let me stop and say, it doesn't matter when I expect to sell the stock. That doesn't change the value. I could sell it at the end of year 1. I could sell it at year 8. Okay, we're valuing the stock at year 4 because that's the start of the expected start of the constant growth period for this stock. So it doesn't matter when I expect to sell it. It doesn't change the value today. So again, I'm going to add together those cash flows. So the value of the firm, the intrinsic value of the firm, is equal to the NPV. The discount rate is 15%, which is the required rate of return for equity. And then I highlight all my future cash flows. It gives me a value today of $58.52. All right. So here we just use the constant growth formula to find the horizon value. In our next example, we're going to use the price to earnings ratio to find the horizon value. So this is a little bit more complicated. In this case, our current dividend is $2. The growth for the next 3 years, oh, sorry, let me stop right there. What we're going to do first is use constant growth to find the value, and then we're going to use the PE ratio to find the horizon value. So we're going to work this one first by just using that constant growth model for the horizon value, and in this case the horizon value occurs in at the end of year 3, because our high growth is 15% for 3 years. So I'll go back out here to Excel. So our growth rate for 3 years is 15%. And after that it's 4%. Our current dividend, our last dividend paid was $2, so that would be our D sub 0. So our dividend at time 1 is expected to be $2.30. At time 2, it's expected to be $2.65. Then I'm just going to pull this out. Again, our horizon value is at year 3 because year 4 starts the constant growth. So I'm going to take the dividend for time 4 divided by the required rate of return, which in this case is 10%, minus that constant growth of 4%, to get us a horizon value of $52.72. I'm going to add these together now. Now mind you, in each instance I'm not including the time 4 dividend or the dividend after the constant growth starts. So in this case, in this example up here, it was time 5. That's not included in my valuation because that's already included in this horizon value. So if I included that as one of my cash flows that gets discounted back, I'd be double counting that cash flow. So my value for the stock is equal to, again, I use net present value here. The rate is the required rate of return of 10%. And the intrinsic value of the stock using this valuation method is $46.17. So now we're going to do the same problem, but instead of using the dividend constant dividend growth model to determine the horizon value, we're going to use the price to earnings ratio to estimate the horizon value. Because so what we're pulling out of this is the price from the price to earnings ratio, and we're determining what the expected price is based on the payout ratio of the firm. Okay. So using the previous example, we'll use the trailing PE. So one thing I want to do is change this problem just by changing one word here. Instead of using the trailing PE, we're going to use the forward price to earnings ratio. So we're going to use the forward PE instead of the trailing PE. Oftentimes, because that forward PE, and I mentioned this before, with the database that I use, Capital IQ, that's the normal PE, the way it's calculated. You could also do this using the trailing PE. It just changes the time period that you're looking at. So using the previous example, we'll use the forward PE to determine the terminal value. The D4 is the dividend at time 4 is $3.1634. So I'm going to go out here, and that's actually the case that with our last example. Okay, so that's not any different. So now in this case, I'm going to delete this, because now I want to find the price at time 3 with the dividend at time 4. And so we're going to find the earnings at time 4 using the dividends. We're going to use the price at time the income, the earnings at time 4, using the dividends for time 4 and the payout ratio. So the payout ratio for the firm, according to the problem, is 60%, so it's 0.6. So they're paying out 0.6 of their earnings as dividends. So to find let me just show you here the math, so it makes a little more sense. So our price to earnings ratio And to be more specific, because this is a forward PE, we're going to use the price at time t plus 1, or the earnings at time t plus 1, to determine the price at time t. So this is a forward PE ratio. So this is equal to the price at time 3 divided by the earnings at time 4, because again it's a forward PE ratio. And so that's what we're looking for, and that's equal to 13.0. Okay. So it's the projected PE. Now we want to find the earnings at time 3, the earnings at time 4, and we have a payout ratio of 60%. They're paying out 60% of earnings as dividends, so I'm going to also put that in here. So dividends per share divided by earnings per share is equal to 0.6. I know my dividends per share is equal to 3.1634. Divided by EPS is equal to 0.6. So to find the earnings per share, I'm going to divide both sides We're going to multiply both sides by EPS and divide both sides by 0.6. So we get 3.1634 0.1634 divided by 0.6 is equal to my earnings per share, or my earnings per share times 4. So let's go ahead and do that in Excel here. So I'm going to take the 3.1634 divided by 0.6, and that's my earnings per share. My price to earnings ratio is equal to 13.0, and so my price, multiplying the price to earnings by the earnings per share, will give us our price, or our estimated price of the stock. So I'm going to put value, and this is the value at time 3, is equal to those two multiplied by each other, or $68.54. Alright, and so now I've got my my expected value of the stock at time 3, my horizon value, and I hope that made sense. We found the earnings per share at time 4 using the payout ratio, dividends divided by earnings of 0.6, and then we used the price to earnings ratio of 13 multiplied by those earnings per share to get the value of the stock, the estimated price of the stock at time 3. So now I'm going to add my cash flows together. So if I purchase this stock today, based on my estimates, I'm going to receive a dividend of $2.30 at time 1, a dividend of $2.65 at time 2, and then I'm going to receive a dividend of $3.04, plus I can sell the stock for $68.54 at time 3, and I discount those cash flows back to today at the required rate of return of 10%. And I get a value today of $58.06. Again, please let me know if you have any questions about that. There's another example of this in the practice problems for this topic area. All we're doing is we're using the price to earnings ratio instead of the dividend discount model. In the past, when I valued companies, I've used this technique because that dividend discount model, that constant growth model, can be very sensitive to a small change in the long-term growth rate or in the required rate of return. And so there's a lot of volatility involved with using that methodology. If the price to earnings ratio for a firm has been fairly stable over time, so it's predictable, this can be a good alternative or another way to try to determine the value of a firm because it's just a little more stable. If the price to earnings ratio is all over the place all the time, probably not a good method to use. But I have used it in the past because it does offer a little more stable value than the constant growth model. The next approach we're going to talk about is the free cash flow models. These have become more and more popular over time, especially since companies have gone away from paying so many dividends. Companies in the United States didn't really start paying out cash using stock repurchases until the early 1990s. It became more legal and more acceptable in the 1980s, but they really didn't jump on board until the early 90s. So prior to that, companies primarily paid out any cash they had to pay out using dividends. And so what's happened since then, though, is Nowadays, the majority of cash that's paid out by a company, by a S&P 500 firm, is paid out using dividends rather than using stock, or excuse me, ignore that. The majority of cash paid out by S&P 500 firms is paid out as stock repurchases rather than as dividends. With that, the free cash flow models have become more important because they don't just rely on a company paying dividends, because theoretically a company doesn't even have to pay dividends anymore. They can get rid of all their excess cash through stock repurchases. And so a lot of analysts have moved more towards using these free cash flow models for the valuation of the stock. Primarily, and we're going to talk about why, but primarily they use what's called the free cash flow to the firm model. The other model is the free cash flow to equity. And we're going to go through the list of reasons why an analyst might use one over the other. Okay. But the free cash flow to the firm model, free cash flow to the firm, is the cash flow available to all of the firm's suppliers of capital. So that includes not only common stockholders, but bondholders, other debt holders, preferred stockholders. Once the firm pays all operating expenses, including taxes, and expenditures needed to sustain the firm's productive capacity. So the idea is this: a company is in business, they have to pay their employees, they have to pay their taxes, they have to pay their insurance, they have to maintain their current equipment, or maybe add on to their current equipment. And they have to do all these things in order to stay alive. And if they stop investing in their fixed assets, they're building their equipment, the company might survive for a little while, but eventually it's going to catch up with them. This really happened to Kmart in the last decade or two, where they really stopped putting money into their stores. I lived about 3 blocks from a Kmart when I was in Wisconsin, and it got so bad there that the roof actually caved in on the store. And this sounds a little wild, but they actually just closed off the part of the store where the roof caved in for a while as they started to repair it. But it had gone so long without just doing proper maintenance on the building that it became a very big problem. They had the same problem with their parking lot. It went decades without being fixed, and it was slowly turning entirely to gravel. And that's what happens when firms don't make those necessary investments. The Kmart store was long ago shut down because it was just kind of hazardous there. So that's the idea behind the free cash flow models. The company pays out everything it needs to pay out to maintain itself, and then what's left over is available to be paid out to the investors of the company, although the firm doesn't have to pay it all out. It is there to be paid out if that's the desire of the managers and the board of directors and the stockholders of the firm. So the expenditures that are paid out include what's needed to purchase fixed assets and working capital, such as inventory. The firm's supplier of capital include common stockholders, bondholders, and preferred stockholders. If the firm has preferred stock outstanding, most firms don't. The free cash flow to equity is the cash flow available to just the firm's common stockholders, so not all of the investors. Once operating expenses, including taxes, expenditures needed to sustain the firm's productive capacity, and payments to and receipts from debt holders are accounted for. And this also includes any debt that is issued during the year. We consider that to be a net debt issued. In other words, if the company, for example, issued $500 million in debt, so they received $500 million in cash, but paid off $400 million in debt, the net debt issued would be $100 million. And this would actually show up as a cash flow available to equity holders. So there are two ways to estimate the equity value using free cash flows. The first way is an entire firm and all of its cash flows are discounted. That's the free cash flows to the firm, with the relevant discount rate being the weighted average cost of capital, because it reflects all of the firm's sources of capital. the value of the firm's debt is then subtracted to calculate the equity value, and we're going to work through an example of this. The second way is that only the free cash flows to equity are discounted, with the relevant discount rate being the required return on equity. This provides a more direct way of estimating equity value. In theory, both approaches should yield the same equity value if the inputs are consistent. However, the FCFF approach would be favored in two cases. In the first case, the free cash flow to equity holders is negative, and this is actually not uncommon with a very young company. So a company just starting out, they use a lot of cash to grow quickly. They use a lot of cash just to cover their startup cost. And so oftentimes for young companies, the free cash flow to equity holders can be negative. In that case, it wouldn't make sense to use that number to value the firm because we come up with a negative value. The second case is when the firm's capital structure, its debt mix of debt and equity, is unstable. The free cash flow approach is more favored here because the first reason, the required rate of return on equity used in the free cash flow to equity approach will be more volatile when the firm's financial leverage or its use of debt is unstable. So as a firm takes on more debt, the required rate of return on equity increases, and the required rate of return on debt also increases. And so it's the required rate of return on equity will become more unstable and less able to predict the value of the firm. And the second case is when using historical data to estimate free cash flow growth, the FCFF growth might reflect the firm's fundamentals better than the FCFE growth, which would fluctuate as debt fluctuates. So the first one, and the one we're really going to focus on, is that free cash flow to the firm. I'm going to work through an example of it with you here. So let me start off by saying that there are many approaches to calculating the free cash flows to the firm. They're generally consistent with each other with a few small changes. The one I'm giving you now is taken out of a popular investments textbook. So it says here, the free cash flow to the firm is equal to the earnings before interest and taxes. So that is often calculated as the operating income for the firm, multiplied by 1 minus the tax rate. So the reason why we do this is that we don't want to take out interest because that is a cash flow available to the bondholders, or in the lenders to the firm. So that's a cash flow we want to keep in our free cash flow to the firm number. So this is essentially operating earnings minus taxes. And because the government will get their share. So we take EBIT multiplied by 1 minus the corporate tax rate. And that gives us what is often referred to as NOPAT. Okay, so I'm just going to add that in here in case that comes up for you sometime in the future. EBIT multiplied by 1 minus the tax rate, the corporate tax rate, and that's T sub C, is equal to NOPAT, which stands for net operating profit after tax. Okay. From that, we add back depreciation expense because it's a non-cash charge. We subtract out capital expenditures, and we subtract out the increase in the net working capital. So our increase in capital expenditures and our increase in net working capital are the investments we have to make to keep the company functioning. Okay, so our net working capital is generally calculated as accounts receivable plus accounts payable, possibly plus accrued expenses, minus, that's not right. It's the net working capital for a firm is the accounts receivable plus the inventory minus accounts payable minus accrued expenses. So it is the short-term assets of the firm necessary to maintain the function of the company, inventory and accounts receivable, minus the liabilities that occur as the regular function of the company. Accounts payable. So if the company buys things on credit, they generate accounts payable, and then also accrued expenses for things such as accrued wages. So these are normal current assets and normal current liabilities necessary for the proper functioning of a company. Okay, so we get those calculations, and we're not going to focus on that in this class and calculating all those things. If you take the portfolio management class from me, we actually get into that, and we use that to value the firm, and I imagine in the financial management class you may have done this as well. So the value of the firm, and I want to change one thing here. We're going to rename this. It's the value of operations. I apologize for that. As I've gone through some problems and things like that, I want to be very specific in the name here. So it's the value of operations is equal to the present value of the free cash flows of the firm discounted back at the weighted average cost of capital. The equation down here assumes a constant growth rate. So this is our constant growth equation. So you can, if you take a look at the constant growth equation for dividends, it's the same setup. We have our value at a specific point in time is equal to the next cash flow. In that case, it's the next dividend, divided by the discount rate. In this case, it's the weighted average cost of capital. For the dividend discount model, it was the required rate of return on equity minus the constant growth rate in both cases. So it's the same equation, it's the same math, it's just different cash flows and different discount rates. The free cash flow to equity holders, FCFE, is calculated as, and we can actually get it from the free cash flow to the firm, is calculated as the free cash flow to the firm minus interest expense multiplied by 1 minus the corporate tax rate. And so what we're doing there is we're adding back the after-tax interest expense, because we're subtracting out the after-tax interest expense because that is not a cash flow available to equity holders, although it is available to one of the investors in the free cash flow to the firm model. So we subtract that out because it's not a cash flow available to equity holders. Then we add in increases in net debt. Or it's probably more accurate to say net debt issuances. So when the company takes out more debt in a year than they pay off, that cash is available and is often used to give to the stockholders. Many companies in the past few decades have done that, where they've taken out debt and they've used that debt to repurchase the stock of the firm. So they're transferring that debt, the proceeds. They're taking out the cash, they're using that cash to pay equity holders. The intrinsic value of equity is calculated as the free cash flows to equity holders discounted back at the required rate of return on equity. So notice that these equations are very similar, just a change in the cash flow and a change in the discount rate. Okay. And again, this is the constant growth value. So one big thing I want you to take away from this is the math for all three of these different models is the same. We're just using different cash flows and different discount rates. Other than that, they're all the same. So we're going to look at a single stage free cash flow to the firm model. The current free cash flow to the firm, we could say the last for the previous year. So times 0 was $6 million. The target debt to capital ratio is 0.25. The market value of debt is $30 million. The shares outstanding is 2.9 million. The required rate of return for equity is 12%. The cost of debt is 7%. The long-term growth in free cash flows to the firm is 5%. And the tax rate is 30%. So the first thing we need to do is calculate the weighted average cost of capital for the firm. The formula says, and the formula is below, says that the weighted average cost of capital is equal to debt and equity component cost. We multiply those by the individual weights. So MV debt is the current market value of debt. MV equity is the current market value of common equity. R sub D is the before tax cost of debt. And R sub S is the cost of equity, or the required rate of return on equity. To calculate the debt component, the tax rate is used because in most jurisdictions the interest payable payments on debt and tax are tax deductible, which reduces the effective cost of debt financing. Equity, however, is not tax advantaged because the payment of dividends does not reduce the firm's taxable income. And this is actually a big reason why companies oftentimes want to take out debt, because the required rate of return on debt is much lower in many cases than the required rate of return on equity, and that lowers the weighted average cost of capital for the firm by taking on debt. So plugging in the numbers from our example, and we're going to do that here in a minute, we arrive at a weighted average cost of capital at 10.23%. Note that the debt to capital ratio of 0.25 means that 25% of firm assets are financed with debt and the other 75% are financed with equity. In some cases, analysts use the term target debt to capital ratio instead of using the current market value weights, because analysts frequently assume that the targeted debt ratio is the one which the firm will utilize over the long term. And there's some research that supports the idea that firms have a target capital structure, or an optimal capital structure that they target. And as time goes on, the firm won't automatically just sit down one day and change their capital structure dramatically, but they'll move towards that optimal capital structure over time. So let's go ahead and plug in the numbers here in our weighted average cost of capital equation down here. And this one might look a little bit different. In some cases, you might see the weight of debt here and the weight of equity here, and that's typically how I teach it. In this example, though, we're actually plugging in the numbers for the market value of debt. Well, we're not. We're going to use the target ratios here. But that's how those weights are calculated. We take the value of debt divided by the total capital of the firm, debt plus equity, and the value of equity divided by the total capital of the firm. So in our case here, our target debt ratio is 0.25, or debt to capital ratio is 0.25. Our required rate of return on debt is 7%. Our tax rate is 30%. Our capital ratio is 0.75 because those two weights have to equal to 1. And our required rate of return on equity, given in the information up here, is 12%. So if I plug this, I'm going to use Excel again. So I have equals 0.25 times 0.07 times 0.7. The 0.7 is 1 minus the 1 minus 0.3, plus 0.75 times 0.12 gives me an answer of 0.10225, or 10.23%. Let me know if you have any questions about that. I just kind of worked through it quickly. For this class, I just want to show you how to calculate, briefly, how to calculate the expected value of a stock. This isn't a valuation class in that sense, so I don't go through a lot of the detail that you might often see in your finance classes. This is just to expose you to the models a little bit and explain which one might be used in different cases. So issues in free cash. So note that here the free cash flow to the firm is discounted by the firm's weighted average cost of capital. If the free cash flow to equity were provided, it would be discounted by the shareholders' required rate of return to obtain the equity value. So now what we're going to do, since we have the equity value, we can now use that, assuming constant growth. So we have a long-term growth rate of 5%, and we're going to use that constant growth model now to determine what the value value of operations for the company is today. So I'm going to use this equation, the value of operations, and the constant growth equation, because that's what it is here. If this is constant growth, it breaks down to this equation. So I'm going to put it here just to be a little bit more accurate. Value of operations. Let me explain the difference too. The value of operations, if the company doesn't have any non-operating assets, then it is the total value of the firm. If a company is being acquired, then that's usually the value that they want to go with, because the non-operating assets usually won't go with a firm when it's being sold. But however, if we're trying to value it for determining what's the value of this company's stock, then what we actually want to do is to find the total value, and that would include the value of any marketable securities or short-term investments and any long-term investments that aren't used in the function of the company. So in this example, we're going to calculate the value of operations for the firm, and then in one of the practice problems, I'm going to work through that with you. I'll show you how to calculate the equity value and the estimated value of the stock. So in this case, the free cash flow to the firm at time t plus 1 is going to be this 6 million multiplied by 1 times the long-term growth rate. Oops. Alright, so that is 6 million multiplied by 1 times the long-term growth rate of 5%. Our weighted average cost of capital is 10.23%, and our long-term growth rate in those free cash flows is 5%. Oops. So our numerator is 6.3 million. Our denominator is equal to 0.0523, and so the value of operations for that firm today is estimated at $120,458,891.01. And rather than try to memorize that or do something else, I'm just going to copy it and paste it over here. Oops, that is not what I wanted to do. Oh yeah, okay, sorry about that, it worked. So that is our answer there. You see it's a very large number, and that's because our denominator is kind of small in this case. It's 0.0523, and so as that gets smaller, the value of the firm increases. So just to think about that for a little bit, what makes that denominator smaller is a smaller weighted average cost of capital, the first number of 0.1023, or a larger growth rate. Okay, so either of those two things changing is going to have a fairly profound impact on that value. So some issues in free cash flow analysis. When determining the free cash flow to the firm and free cash flow to equity, analysts should be aware of the following issues: discrepancies between balance sheet items and free cash flow statement items. The reasons for this are firm acquisitions and divestitures, meaning that a company buys another company or it spins off a company or sells off a division, and the presence of foreign subsidiaries. So that's when a company owns another company in another country. The analyst should adjust cash flow projections for these contaminants. Dividends versus free cash flows to the equity holders. So if you think about it, the dividends are just a portion of the total free cash flow available to equity holders, unless they're paying out everything to those stockholders. And a local case of this is Capital Federal Bank, at least until a couple years ago, and I haven't stayed on top of it, although it looks like they're maintaining this policy, is they just pay out all of their income. Any money they come in, they pay out, and at least for a while, and I think they still are, they actually pay out a little bit more of their income because they had some additional equity that they kind of needed to get rid of or would like to get rid of, and so they pay that out to their current stockholders a little bit at a time. And really what happened there was that several years ago, Capital Federal went from a mutual bank to a publicly traded bank, and so they switched their ownership type, and as a result they had extra capital, extra equity on their books. And not always the best thing, it's nice for a bank to have that, but it's not necessary, and it can benefit stockholders when they pay that additional money out. And so that's what they did, and that's what they've been doing. So in that case, really the free cash flow available to equity holders is all paid out as dividends. That's kind of rare, though. So firms with low dividends, a young startup, usually also have low free cash flow to equity because they have large capital expenditures are facing difficulties. However, many analysts consider FCFE more relevant than dividend discount models because, in the first case, for firms that pay no or small dividends, future dividends are difficult to forecast. And secondly, for firms being valued for acquisition, the acquirer can in the future control all of the firm's cash flows. And if you remember back with dividends, if you're a controlling shareholder, you really want to use that FCFE model instead of the dividend discount model. And then finally, FCFE is often a better indicator of future shareholder wealth because it reflects all the cash flows available to the equity holders, not just those paid out. So this last point is critical. You will be asked about it in the future. Effects of dividends, repurchases, share issuances, and leverage on FCFE and FCFF. So this is key. Dividends, share repurchases, and share issues do not change the free cash flow to equity holders and the free cash flows to the firm. Because if you think about it, we start with the operating income generated by the company. We pay out everything that's required to be paid out to maintain the company. And then whatever is left, depending on the type here, FCFE or FCFF, sometimes we also deduct out the interest being paid, and sometimes with FCFF we don't. But in no place are we taking into account cash being paid out to equity holders for dividends or for stock repurchases, because that comes out after we've calculated these cash flows. Okay. With these calculations and the numbers we're getting, we're finding the cash that is available to be paid out to the equity holders for the FCFE and to all the investors with FCFF. And so those being paid out don't affect that number. Okay. In other words, a stock repurchase program where the company is paying out cash for stocks affects the distribution of available cash flows, but not their availability. Okay. Increases in leverage do increase FCFE by the debt issued in the year that it's issued. Future FCFE increases by the tax savings from the interest tax shield. So what that means is that whenever a company takes out debt, they get to deduct the interest expenses from their income for tax purposes, and this creates an interest tax shield. And to a certain degree, a firm taking out debt can increase the value of the firm by both reducing the weighted average cost of capital and by creating this debt tax shield where their taxable income goes down. However, when a company takes on debt and they start paying out interest, that interest is also deducted from the cash available to pay out to equity holders. And that's the future interest payments paid to debt holders here. FCFF only changes by the tax savings from the interest tax shield. When comparing the outcomes from the different models, you need to recognize the assumptions that were made for the models and determine which ones seem more reliable and which ones less. For example, for a firm that has a high market value of equity relative to its book value of equity, the value is coming from the intangible items and expectations that are probably more risky than the value of the physical assets. That's what I was talking about in the last video when I talked about Tesla, where most of their value is coming from the expectations of the future of the company rather than what the company's achieving right now. Okay? And those companies, in terms of investments, are riskier because we're betting on the future of the company rather than what the current operations are. So this is the end of these notes. Please let me know if you have any questions. I'm going to create one other video, but probably not in the next day or two, going through working through the problems for this topic, because I do have some stock valuation problems that are a little more detailed than the ones I went through here in the notes. If you have any questions, please let me know. As for the class after this, I've got another video already prepared on option strategy. So now we're going to get into some stock options. That video goes through different option strategies and really what call option and a put option do, and how to create portfolios with those options. And that's all ready to go. And I'm gonna put that online in the next day or so. And then with that will come your last assignment in the class, where I'm going to give you situations where you can, where you have to determine which option strategy to use in a certain situation and what the payout will be from that strategy under certain outcomes. The last video that I'll put out here probably in a week or so has to do with option valuation itself. I'm going to do this option valuation. I'll show you how to do it on paper, but I'm also going to show you how to do this in Excel, because that's honestly how I do it. It's a lot easier once you get a spreadsheet all set up to do those option valuations, and so I'm going to demonstrate how to do that in that final video. Please let me know as you come across questions. I'm going to put out a quiz for this as well, and I hope you have a great weekend, and I will talk to you soon.